Over the last few years, we have seen inflation shocks, geopolitical tensions, AI disruption, and changing global alliances. Are we entering a fundamentally different economic era globally?
Largest commodity that still trades in the dollar today is crude.
Do you believe India is entering its strongest structural growth in the decade to come?
India was the largest country in the whole world by population size. And I always tell people there are only two types of investors in this world: lucky investors and unlucky investors. That's all.
Hello and welcome everyone. Today we are joined by Mr. Arjun G. Nagarajan, Chief Economist, Communication Strategist, Commodity Fund Manager at Sundaram Mutual Fund. He also manages the Sundaram Multi-Asset Allocation Fund. At a time when the world is navigating through geopolitical shocks, inflation risks, oil pressure, energy transition, and changing economic power scenarios, very few voices are able to connect macroeconomics, investors, commodities, and investor behavior as clearly as he does. In today's conversation, we'll discuss global markets, India's structural long-term opportunity, commodities and capital flows, portfolio strategy, and investor behavior. Mr. Nagarajan, wonderful to have you with us.
Pleasure is all mine.
Over the last few years, we have seen inflation shocks, geopolitical tensions, AI disruption, and changing global alliances. Are we entering a fundamentally different economic era globally?
It's actually a very, very interesting question. Thanks for having me. Answer is a yes and a no. So the yes comes from the angle where this entire Israel, US and Iran war, people look at it as that. But the underlying tensions are not between US and Iran. The underlying tensions are between US and China. So 90% of Iran's oil exports are to China. It has been in yuan. 90% of Venezuela's exports of crude was to China. It was in yuan. And almost all of the penalties that Iran is collecting through the Strait of Hormuz, through whatever ships are actually passing through, are in yuan and some in cryptocurrencies. China is the second largest country in the entire world now after the United States. So let's say 15 years, 20 years down the line, one shouldn't be surprised that if China becomes much larger, which then means that the petro-dollar narrative could also become a petro-yuan narrative. There is always a likely possibility that happens. There is a very underlying narrative that has been doing the rounds for a long time now, that the largest export of the United States, a lot of people see that the largest export of the United States to actually be the dollar rather than anything else. Whenever there's a problem, the US prints their way out of it. And the largest commodity that still trades in the dollar today is crude. So if a good part of crude starts trading outside of the dollar, it is a threat, a structural threat to the United States to a certain extent. So I come back to this narrative of de-dollarization. If you had asked me any time in 2025, if de-dollarization was a realistic possibility, I would say, yeah, maybe 20 years, 30 years down the line, but not in the immediate future. If you ask me the same question now, I can't say that with the same amount of confidence. Maybe a 99% probability, even for me, that a de-dollarization is much further into the future. I'd say maybe I'm probably only 80% as confident that the de-dollarization won't happen immediately. It will take a much longer period of time because the geopolitics, the dynamics are shifting faster and at a pace and a direction that I don't think we understand. So the recent meeting between the US president and the Chinese president, there was this mention of a Thucydides trap that Xi Jinping was actually talking about. That brings this entire thing into context, trying to talk about how two large emerging powers, how they have to deal with each other. I still would hope that the de-dollarization narrative and all of this is not going to really come through in a very big way. But there is still a risk given that UAE has now broken away from the OPEC. So if one member breaks off from the OPEC, is there an increasing probability that more would? Is there an increasing probability that people could start aligning away from the dollar from a crude point of view? These are questions that I don't think there are clear answers to. So in my mind, I don't think there is a structural shift happening, but the pace at which things are happening, I can't rule it out completely. So one will have to very closely watch the geopolitical space and these narratives to try and see if there is an indication that there could be something a decade or two down the line. Might not be anything immediate, but 15 years, 20 years down the line, this could be the start of some crack that's forming into the future.
Yeah, I mean, that's quite a fascinating perspective. And it naturally brings us to the topic of commodities and resources, which are becoming central to many of these global economic shifts. So in fact, for a couple of decades, it was technology which was dominating the markets. But today, with AI, infrastructure spending, energy transition, and geopolitical shifts, are commodities becoming structurally more important than before?
It looks like they are. From an AI point of view, I think it is a question that nobody seems to really have an answer to. The amount of disruption AI can bring or AI is bringing is something, the answer is ever evolving. Nobody is exactly able to even understand. For example, you look at the IT space, IT software space in India, I don't think people have a clear idea as to how much this disruption is actually going to cause from an employment point of view. The minute they're able to put a handle to it, then you can take a call in the IT space in entirety, because one driver is the currency, the other driver is the Indian BFSI space or the US BFSI space. If the US BFSI space does quite well and currency continues to remain fairly weak, IT can look attractive, but one is not able to very clearly put a finger to that because of the amount of AI disruption that could possibly come. So that is still a question mark. On the commodity space, on the renewable space, I think this entire conflict is clearly pushing India into the renewable space at a pace much faster than that we've seen in the recent past. My initial commentary, or rather initial thought, used to be that, okay, if India shifts a significant way away from crude and crude derivatives away into the renewable space, won't we still have to import a lot of EV related imports? So it's just going to be completely substituting crude with EV related imports, was my initial thought. But the conversations I've been having with a number of people in the last few days, it does look like, at least on renewable space, on the solar power space, it looks like we might reach a stage of a certain level of self-sufficiency, which can structurally bring down our imports, our energy imports, to a large extent, depending on the pace at which we move into the renewable space. So commodities, yes and no. So the only commodity that is actually there in the minds of everybody, every investor at this point in time, is gold and silver. So gold and silver, I have a very different view. I always tell people that if you're looking at gold, everybody's carried away by the fact that the last 7 rallies in gold have been double digit. They're only taking care of the only thing that's on their mind is these rallies. They forget the fact that gold has actually corrected a sharp amount after 2012. So if I look at data and I want to find a time frame for gold where gold has never given you negative returns, the number I get is around 7.5, 8 years. So if I look at blocks of 8 years, that is the only time where I have seen a 0% probability of negative gold return. So that way, that then tells me that the probability of gold returns from a time frame point of view, it is much more volatile than probably a mid cap. But people don't really look at it that way. And returns in gold in rupee terms, I think it should be somewhere closer to a 10% CAGR rather than a 12% CAGR, because the probabilities are, for a 10% CAGR, a 60% probability, but for a 12% CAGR is less than 50%. So the gold is one commodity that comes to my mind. So till mid 2027, I feel gold as a commodity can sort of hold up at these levels, or probably inch up a little more, because it is only uncertainty that seems to be driving this entire gold move. So post mid 2027, if I assume that the rates uncertainty, global geopolitical uncertainty starts to fizzle out, risk on the equity side will start coming back all over again, and gold won't really have that much of a shine at that point in time. So from a gold point of view, I think that's how I look at it. Silver, I think it becomes a very tricky commodity because in addition to being a precious metal, it is also a trading commodity. It's also an industrial commodity. So the amount of volatility that you probably see in silver is much more, which sort of tells us that probably stay away from silver. So for example, in our Sundaram multi-asset fund, there's only one commodity we have, and the reason why we have only gold in it is because of this reason, because it's a simpler commodity to look at. The dynamics and the number of other variables that interfere are relatively minimal. So the only commodity we have in our multi-asset fund is gold, and that too, we have a fixed 20 to 25% allocation in gold. We never go below 20, we never go above 25. So that a very long answer to your question, but yeah.
Interestingly, I mean, traditionally investors have viewed safe asset classes like gold, which are pretty safe during times of uncertainty. But recently, talking about gold, we have seen even gold correcting during the recent crisis. So what does this tell about investor behavior and the changing market dynamics?
So the correction in gold starts around end of January this year. That comes exactly around the time when the US President Donald Trump announces Kevin Warsh as a Federal Reserve Chair nominee. Now, it was a surprise to everybody because Trump, as Donald Trump, the US President, as an individual, has always been pushing the Fed for more rate cuts. And so in a sense, he wants somebody who would probably cut rates more, but he nominates someone who is known for their hawkish stance and who is known for not liking interference in the Fed by people outside the Fed. So it was a big surprise to everybody, and it was a hawkish, negative surprise to everybody, and which is why you actually started seeing gold coming off. This week, I think it is Friday, is when Kevin Warsh actually assumes chairmanship. So this week can probably be fairly important for gold from a sentimental point of view, because if he comes across or if he passes statements that are relatively hawkish, that could affect sentiment for gold, at least in the near term.
I'm sure markets are going to watch that very closely.
Very close. Yes.
So, despite this global uncertainty, India as a country continues to stand out. Do you believe India is entering its strongest structural growth in the decade to come?
Yes. This is a topic that is very close to my heart. I can go on for hours just on this. I will try to keep it as short as possible. From an India point of view, a standard blanket statement I tell everybody is, if anybody is negative on India, it can only be a tactical sell in India. No one can, in their sane mind, can ever be structurally negative on India for a very long time to come. I'll give you three pointers that really stand out for me. 2025, India was the largest country in the whole world by population size. We are the most populous country in the entire world. We've beaten China in 2025. We are today 15% of the world population. The entire world's population, one country is 15% of the entire world's population. In another few years, we will become 18% of the entire world's population. But the catch is here, even after 100 years, even when we are at 2,125, 2,126, we will still be the largest population in the entire world. We will be somewhere between 12 to 14% of the world's population. The next size populous country will be China at 8%. Which means India is going to be relevant for more than 100 years from a population point of view. And I keep telling people that India is the only country that is so large which is going to make such a difference to the global narrative. In addition to that, India is the only country where you're actually seeing everybody's disposable incomes continue to grow every single year. After the year 2000, every decade, India has grown not less than 6%, always north of 6% real GDP growth. India, within the next 6 to 7 years, we will be the third largest country from a GDP point of view. So, the largest populous, most populous country for the next 100 plus years, the third largest country within the next 7 to 8 years, minimum 6% real GDP growth, decadal real GDP growth since the last 25, 26 years, and 21% of the global working age population comes only from India. And from a skilled point of view, 25% of global engineering graduates come only from India. So whether it is skilled workforce, unskilled workforce, however you look at it, India is the place to be. So I do not see any structural negative from an India point of view directionally, and there is no reason for anybody to be negative India if you're a long-term investor. It is a no-brainer investment opportunity from a long-term investment standpoint.
That should give a lot of confidence to foreign investors as well. So we are witnessing a world which is shaped by, again, volatility, inflation uncertainty, geopolitical risks, and shifting market cycle. So does multi-asset investing become more relevant today than before?
Fair enough. I have a tricky answer to this question. So I tell people that go in for asset allocation if your time frame is short. So I tell people that if your time frame is long, go in for 100% equity. So I tell people that their risk appetite and their exposure to equity have nothing to do, their age and their risk appetite has nothing to do with each other. I know people who are 80 years of age who are 100% in equity, 20 years age, younger chaps who are probably only 10-20% in equity. I tell them their exposure to equity is directly dependent on their financial goals and when their financial goals are. So if my financial goal is 20 years down the line, I'm saving for my retirement. For the first 15 years, 100% of my money should be in equities. The last 5 years, I have to start reducing my equity allocations. So for any investor whose time frame is less than 5 years, then I think multi-asset becomes a great asset class to actually invest in. So the only catch I tell people is if you are investing in multi-asset, now today, for all reasons, for all purposes, multi-asset is seen as a gold proxy in a certain sense. So I tell people if you are investing in a multi-asset fund from a gold point of view, see to it that the component of gold is a fixed component. It is not a variable component. In the sense that, say, for example, suppose there is a multi-asset fund where the weightage of gold is 0 to 30%. In case the fund manager's call on the cycle of gold goes wrong, the whole purpose of investing in the fund goes away. So for that reason, when we actually had our Sundaram multi-asset fund, we had a very clear mandate, and especially from the board, saying that we will never ever go below 20%. And we won't go above 25%. So 20 to 25 is our lower and upper levels, and 22 to 23% is always how we sort of maintain it. So if your time frame is, let's say, in the next 1.5 years, I think multi-asset fund as a product makes a fair bit of sense. The biggest advantage is that from a taxation point of view, because there's a certain amount of arbitrage, 65% is your net equity exposure. So you have equity taxation as well. And the gold component really stabilizes your portfolio returns to a large extent, and that's the whole point of asset allocation, where you have an asset class that is negatively correlated to equities, and it stabilizes when there's too much of volatility from an equity point of view. So multi-asset funds, I am positive multi-asset funds from a short-term point of view. One variable that one has to very closely watch is where is the narrative around from the Federal Reserve. How is that going to play out? At least till mid 2027, I think gold will still hold up, because I don't see the uncertainties globally completely going away immediately, especially around geopolitics. So I think multi-asset seems realistic as an asset class from a 1.5 year short-term time frame in that sense.
And still a strong case for holding gold in your portfolio.
Yeah, in the near term. Yes.
Yeah. And in today's world of constant news flows and short attention spans, what do successful long-term investors do differently?
I think there used to be a Hero Honda ad a long time ago when I was a kid. It said, "Fill it, shut it, forget it." So they like a lot of people say, the biggest enemy to your portfolio is yourself. And today, with the advent of all these apps, every 5 minutes people look at their portfolios. Every 10 minutes people look at their portfolios. I tell people that if your portfolio size is 1 lakh, the market goes up 10% in 2 months, you're not really bothered. Market goes down 20% in 2 months, you're not bothered. But if your portfolio size crosses 1 crore, the same market movement upwards and downwards, you react completely differently. Because you are not seeing your portfolio moving up in percentages, you are seeing your portfolio moving out in absolute terms. You're like, hey, my 1 crore is actually reduced to 75 lakhs, to 80 lakhs. So it is that human behavior that you will have to check. The only way to check it is build a framework, build a process around this entire thing in such a way that it keeps you out. So you take a long time, take your call, figure out what your right investments are, take your thorough time to look at those investments. Once you decide this is what it is going to be, just forget about it. Let the investment take care of itself. So when I was a kid, I used to go to the railway station to actually buy tickets. So one thing I used to always observe was, I'm in queue number 1. Queue number 1 is very, very slow. It's not moving at all. I see the second queue going very fast. I switch to the second queue. The third one's going faster, and then I go there. The first one goes even faster. So that's the problem with investing. Everybody, they're looking at returns, which is effectively a rear view mirror. And they say, hey, this fund's giving much higher, that's higher, that's higher. You keep switching, and in the process, you're actually missing the entire picture. You're losing transaction cost, you're losing the entire opportunity of compounding because you're switching so frequently. So I think building a process around your investment in such a way that it keeps you out of the equation after your first decision of making that investment, I think that's the most important.
As they say, I mean, doing well with money has less to do with, again, how intellectual you are, and
True.
how knowledgeable you are, and more to do with your behavior.
Very true. Very true. As far as you know who you are, what your pluses are, what your minuses are, and build a framework to protect it from you, that's all you have to do. So it's fairly simple if you ask me.
Let's close with a quick rapid fire round. So one asset class you are most bullish on in the next decade.
Equities.
One global risk which investors are underestimating at this moment.
In the short term, I wouldn't say underestimating. Currency was what I was thinking of, but I think everybody is predicting it well. So 3 C's are the concerns that markets have at this point in time: crude, currency, and a bit of China. So it's not one answer, it's a much longer answer.
I take that. One book every investor should read.
Not on investing, but Atomic Habits by James Clear. Phenomenal. It actually helps you build that framework, build that discipline around everything. It tells you this is the process, try to figure the process, build systems around it. So it says, I think there's a very beautiful quote from James Clear. Let me see if I can recall that. No, I'm not able to get it. So, it's James Clear, Atomic Habits.
Maybe not exactly from the book, but something around that theme. As they say, I mean, both good and bad habits done regularly, they compound. Right?
True.
So choose wisely.
True. Very true. Very true. Very true.
And I think coming to investments also, but they say, I mean, even an investment done in an average fund and held for an abnormally long period of time does wonders.
True. Very true. Very true. So we had done a study a long time ago. We had taken 10-year SIP returns, and we tried to see beyond, if you continue your SIP beyond 23, 24 years, the difference between the luckiest SIP return and the unluckiest SIP return reduces to barely a percentage or two. And I always tell people there are only 2 types of investors in this world: lucky investors and unlucky investors. That's all. You can't increase your good luck. You can't increase your luck. What you can do is invest for the longer term and reduce your bad luck to a large extent.
Absolutely. So, last two questions. One habit that made you successful.
I don't know if I'm successful. We're always attempting. We're trying hard towards that goal. I shouldn't be very presumptuous to answer that question.
You feel, yes, I've done something right. I mean, so this has worked for me. I mean,
I think there's no shortcut to success. That hard work is the only other way. There's no other way to it. That is something that I've understood. So you have to slog those hours. You have to clock in those late nights. That's the only option I can. That is the only way I see things, even going forward. And never letting your guard down, and never think you even know anything. Always, they always say, the minute you identify yourself with the amount that you don't know, it really keeps you grounded. Never identify with what you know. Always identify yourself with what you don't know.
And that keep that hunger for learning on.
None of us know anything. We're always learning.
Learning, absolutely. And so, if not economics, what would you have pursued?
Philosophy. Always.
So I can see you're already a bit of a philosopher. So, Mr. Nagarajan, thank you so much for an incredibly insightful session. Thank you for helping us understand better the global markets, India's structural growth story, commodities, and investor psychology, and the mindset which is required for long-term wealth creation. And thank you to everyone for who has tuned us. If you enjoyed this conversation, please do share this with somebody who would be interested in investing and creating long-term wealth. So until next time, stay tuned, stay invested, and stay disciplined. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.